How is everyone doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to get in with everybody what is going on at the U.S. Treasury. I have covered this before in episode 207 a couple months back, and Janet Yellen continues her manipulation of the Treasury markets and thus interest rates. And so we're going to take a look at a couple things today. We're going to take a look at a recent article from the Epoch Times. We're also going to look at some Treasury market data from the Wall Street Journal, and we're also going to look at the Fred data index from the St. Louis Federal Reserve on the national debt, so we can try to get a clear picture as to what is happening at the moment. So with that being said, I want to bring in, so let's take a look at this article from the Epoch Times called U.S. Treasury Plans to Borrow $1.37 trillion over the next 6 months. That is with a T, ladies and gentlemen. That is the $1 trillion, $1.37 trillion. And the national debt is poised to reach $36 trillion soon. So the Federal Reserve plans to borrow $1.369 trillion over the next 6 months, the U.S. Department of the Treasury announced on October 28th. According to the latest marketable borrowing estimates, the Treasury expects to borrow $546 billion from October to December. This is $19 billion lower than the department's July announcement, largely due to a higher beginning of quarter cash balance, partially offset by lower net cash flows. Washington borrowed $762 billion from July to September, which was $22 billion more than projected. In the January to March quarter, the Treasury then plans to borrow $823 billion, assuming an end of March cash balance of $850 billion. This 3-month period potentially coincides with another round of debt ceiling negotiations and expectations that Congress will raise or resuspend the debt limit. If the forecasts are accurate, the first quarter 2025 borrowing would represent the largest nominal amount for this period. The government's latest projections were released ahead of its quarterly refunding announcement on October 30th, in which the Treasury Department will outline its plan for long-term debt issuance. In recent years, the U.S. government has issued trillions in short-term debt securities. That is the key. Short-term debt securities. Therein lies the market manipulation by Janet Yellen. So short-term debt securities, bonds that mature in terms ranging from 30 days to 1 year to manage higher interest payments and growing budget deficits. The federal shortfall was $1.83 trillion for fiscal year 2024, the third highest on record. So that is a $1.83 trillion budget deficit. So that means the federal government spent $1.83 trillion more than what it brought in. If you remember back a couple years ago, Joe Biden said that there was no way that the government was going to be running $2 trillion budget deficits, that he had all these great plans, and Janet Yellen came out there and all said, oh, no, we're going to spend all this money. We're going to go on this absolutely ridiculous spending binge, but it's not going to lead to these massive deficits. Of course, it did lead to the massive deficits. And now here we are. And Janet Yellen, like I said, has been, putting all of this into these short-term treasuries to manipulate interest rates. And we're going to look at that more in just a second. But let's see here. While Treasury Secretary Janet Yellen has told lawmakers that she is not timing the financial markets. Sorry, something in my throat there. Senator Bill Hagerty suggested this past spring that the current administration was waiting for the Federal Reserve to start cutting interest rates. Private sector estimates suggest that Treasury bills will represent 40% of net Treasury issuance. Lackluster domestic demand has recently challenged the Treasury as foreign investors have dominated auctions. The Treasury auction of $70 billion in 5-year notes resulted in a higher than expected yield of 4.138%, caused by sluggish investor demand. Nearly 77% of the supply was purchased by international investors. Last year, the Treasury Borrowing Advisory Committee concluded that issuing short-term bonds can be cheaper for the government than selling off medium and long-term debt securities. However, while it had been expected that the Fed's reduction in interest rates would result in lower U.S. government bond yields, the Treasury market has rocketed over the past month. Oh, that's very interesting. So the Fed is cutting rates, but yet the Treasury market rates are skyrocketing. That's fascinating. We're going to look at that more in just a second. The benchmark 10-year yield has risen by more than 60 basis points since the September 16 low. It surged to as high as 4.3% during the October 28th trading session, the highest level since July. Now, it has risen by 60 basis points. How much has the Federal Reserve cut basis? Oh, that's right. The Federal Reserve has cut by 75 basis points, but this has risen 60 basis points. So it's almost break even, almost break even on that. It was a classical case of buy the rumor, sell the news, said Adam Turnquist, chief technical strategist at LPL Financial, said investors priced in lofty rate cut expectations ahead of the highly anticipated September FOMC meeting. And even though the Federal Reserve delivered a 50% interest rate reduction, investors sold the news, sending Treasury yields notably higher. In fact, 10-year yields are now up over 50% since September 28th rate cut. Monetary policymakers announced a 50 basis point interest rate cut in September, the first reduction in more than 4 years. The summary of economic projections suggests that more rate cuts will follow over the next 2 years, with the median policy rate expected to fall to 2.9% by 2026. Fed Chair Jeremy Powell has suggested that he and his colleagues can take it slow on the way down to lower rates. This is not a committee that feels like it's in a hurry to cut rates quickly, Powell said at the National Association for Business Economic Events last month. And then a 36 trillion milestone incoming. According to Treasury data, the national debt topped 35.8 trillion on October 24th, 3 months after reaching the 35 trillion milestone. Now, this is important to understand. We are basically adding $1 trillion onto the national debt every 100 days. So what did that say? On 3 months, in 3 months' time, we went from 3.5 trillion to 3.5.8 trillion. And now we're going to, like I said, 100 days. What's 3 months? 3 months is 90 days. Add another 10 days onto that. We go over that $1 trillion mark. So higher interest payments have accelerated the federal government's ballooning public debt levels. In the last fiscal year, net interest charges ate up about 1/5 of revenues. That means that the amount of interest that the government is paying just to service this national debt is now over $1 trillion. It is the single largest line item of expense the federal government has. In its latest October fiscal monitor, the International Monetary Fund, the IMF, stated that increasing U.S. debt and deficit levels have a low probability of stabilizing by 2029. IMF economists predict that the budget deficit will stay above 6% of gross domestic product until at least 2029. Additionally, their short-term outlooks were also revised higher, with the deficit anticipated to be 7.3% of GDP in 2025, up from previous forecasts of 7.1%. Under current policies, the U.S. public debt is not stabilized, reaching almost 134% of GDP in 2029, the IMF concluded. Just so everybody understands, basically, when you go over 100% of GDP, you're in the danger zone. When you get over 105% and then you get over 108%, you're in catastrophic territory. When you go over 120%, that's usually game over. That means you are completely and totally broke. We're approaching 139% of GDP by 2029. That's only 4 short years away. Neither presidential candidate this election cycle has presented a plan to address the national debt. Mark Malik, chief investment officer at Siebert Financial, said, in reality, and we have history as our guide, the spending will more likely not be paid for and the overall deficit will increase. Like, how will those expenditures be paid for? Of course, through increased borrowing, Malik said in a note viewed by the Epoch Times. So yes, and so we have to, the country has to get its arms around this national debt crisis. And now let's take a look at this. So here's our national debt. And basically this, and you have to look at this chart from this perspective, from the last last 50 plus years. I mean, this is going back to 1971. This goes January 1971 to today. And you can see how, even in 1975, our debt was minuscule, $509 billion in 1975. I mean, look at this over the last 50 years. Our national debt has just, gone out of sight. And now to the fact that we're up to 35, 35, almost $36 trillion in national debt. And you can see how it has ballooned here. And just since 2020, we've gone from 26 billion up to, 35 billion. It's just unbelievable how much we've gone, how much this has exploded in just the last 4 years. And so the first thing you have to do, we saw in that article there that we have, we're running annual deficits of almost $2 trillion. Like that's where you have to start first. Like before you can fix the larger problem, you have to stop the bleeding. So we have to get back to a balanced budget. We have to cut $2 trillion in spending out. We got to major cuts. We need to get that down, get back to a balanced budget, and then hopefully we can begin to put together a plan for how we're going to start to chip away at this, and then hopefully bring this back down to hopefully get down to 120% of GDP, 100% of GDP, 80%, 70%, and work our way out of this, just this absolute massive hole that we're in. So let's take a look at treasuries here for a second. So I just want to show everybody a couple things here. So here's the 10-year treasury note. Like, what do you notice here? So we were down on, and let me go back here. Let's go back 3 months. Okay, so September 16th, we were here. We were at 3.6%. And then around September 30th, right in here, we were at like 3.7%. And this is when the Federal Reserve did the 50 basis point rate cut. And now we have skyrocketed up 60 basis points since the Fed started cutting rates. Now, and I want you to stay with me here for a second. All right, let's look at the 1 month. Hold on, I messed that up for a second. Let's look at the 1 month T-bill, and let's go back. Let's look at the year to date. Wow, that's interesting. So this is the short-term T-bills that they were telling you about in the article at the beginning. So what happened here? So September 24th, when the Fed started cutting rates, oh, look at that. We literally go from 5.3 and now we're down to 4.5. And you see that, look at this, the 3 month, the 6 month, the 1 year, all what? All going down. 2 year. Oh, look at that. 2 years spiking up. 3 years spiking up. 5 years spiking up. 7 years spiking up. 10 years spiking up. 30 years spiking up. So all of the longer T-bills are going up. Why is that? Well, because Janet Yellen has been financing all the debt that they talked about, how they took out the, 5 point, let's go back here. And it basically says in here that they took, in January, the Treasury, let's go back here. Like, the Treasury expects to borrow, $546 billion from October to December. Earlier in the year, from July to September, they borrowed $762 billion. They did all that in short-term T-bills. And Janet Yellen did that to manipulate. Let's look at the 10-year. And again, let's go to the 1 year. So what was happening here? We started off the year at 3.9. Then it goes up here to 4.6. That's not good. What's happening? Mortgage rates, interest rates going up, mortgage rates going up. Not going to be good for a certain party's reelection chances, is it? So then we get this brought all the way back down to 3.6. But then basically that was about as far as they were willing to go with it. And now the Federal Reserve goes, oh, okay, we need to start cutting rates. Janet Yellen says, oh, okay, that's perfect, because now I'm going to start rolling over all of this debt. This $1 trillion in debt that has now been borrowed on the short-term securities is now got to get rolled over into the longer-term securities. And so that's what you're seeing. You're seeing shorter-term debt get rolled over into longer-term debt. Now, but you have a problem. You have a couple problems here. You have investors, like I said before, China and Japan, the two largest buyers of our debt, do not have an appetite for this right now. What did it say here? Oh, they did the auction They did the auction, but they had weak demand. They had weak demand. And then where I'm just trying to see if it says in here. I was trying to see where that, you got the debt ceiling stuff coming up here. I was just trying to see here where, basically said that all right. Well, lackluster domestic demand has recently challenged the treasuries as foreign investors have dominated auctions. However, the Treasury auction of $70 billion in 5-year notes resulted in a higher than expected yield caused by sluggish investor demand, and nearly 77% of the supply was purchased by international investors, but not the two biggest ones. And this is the problem. If those players are going to get back in and start buying more of this long-term national debt, basically of ours, then they are going to want higher rates. They view it as riskier debt because what did the IMF say here at the end of the article here? Oh, we are not stabilized. Under current policies, the U.S. public debt is not stabilized. Reaching 134% of GDP in 2029. That's risk return. That means that our national debt is riskier, meaning that anybody that invests in it is going to demand a higher return, which is going to drive these notes up. It's going to drive their rates up higher. Right now the 10-year Treasury is sitting at 4.44. Watch for 4.5. If it breaks over 4.5, look out, because that means it's going to go. If it breaks out over 4.5, it's probably going to shoot up to 5%. And that is a problem, because then the Federal Reserve might pivot, because they might sit there and say, oh, you know what? All those rate cuts that we're doing, they're not having an effect. They're not doing anything, because all of the long-term treasuries are now going up. And so as a result, because remember, everything runs off this 10-year T-note. Your credit card payments, your auto loans, your mortgage rates, it all runs off that 10-year T-bill. So even if the Federal Reserve is reducing rates, if that 10-year T-bill is going up, all of the rates on all the debt that you're going to pay or could pay are all going to go up. So it's, so again, I would not, what I am expecting out of the Fed is that the Fed is going to do another quarter point rate cut in December, and then they're going to pause, because they're going to say, hey, we took the rates down 100 basis points, and now they're going to pause in January and basically say, okay, let's see what this looks like. Let's see where this is going. I don't envy the next Treasury Secretary. There's a lot of talk about who that person's going to be. I don't envy that person, because they are going to have, Janet Yellen has left them a colossal mess. I don't like Janet Yellen. I think Janet Yellen should have been fired years ago. I think Janet Yellen basically morphed into a political hack these last 4 years. I think it's kind of a sad end to a great career otherwise on her part. But I'm going to have a lot more to say in the months ahead about the legacy. If anybody has gone and watched the Lords of Easy Money series that I did, you will know that I am a critic of the Fed. In particular, Ben Bernanke, Jan Yellen, and Powell, all three of them, I call them the three amigos. The three amigos, their legacy is all tied together, because all of this crap over the last 16 years that has happened has all been because of them on their watch. It's all the things that they have advocated, and the three of them are thick as thieves. They work together through all this stuff, and each one followed the other, continuing the policies. That was the dirty little secret, the dirty little lie between the three of them. They all wanted to just continue what each one was doing. And it has now led us to this giant mess today. So I think when we look back, I truly believe this. I truly believe in 30, 40 years, 50 years, when we have a chance to look back on the legacy of these three, people are going to look at them as the three people that wrecked the U.S. economy. I truly believe that. And in time, I believe that is how they will be viewed. And like I said, there's just going to be this colossal mess from Janet Yellen that the next Treasury Secretary is going to have to clean up. And I just want people to understand this, because this is so important, because it's going to impact all of our lives. And I think 2025 is going to be a very bumpy year, because unless the federal government can get their hands around the debt situation and can get the spending under control, this is going to become a bigger and bigger problem. So all right, that's what I got for you guys today. So if you liked this episode, please make sure to like, share, and subscribe. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel, and I will be back to everybody again real soon. Thanks a lot.